If you're new to investing, share prices, also referred to as stock prices, can be a bit of a mystery. They go up and down and barely stop fluctuating. But why? What are the factors that decide where share prices land? While there are many factors that affect a stock's price, there are basic principles that can help give you a sense of why a stock is valued the way it is. In this video, we'll try to give you a better understanding of how it all works. How are stock prices determined? After shares of a company's stock are issued in the primary market, they will be sold, and continue to be bought and sold, in the secondary market. Stock price fluctuations happen in the secondary market as stock market participants make decisions to buy or sell. Stock prices are dependent on the forces of supply and demand. If you're not familiar with these, it simply means that prices will rise when there are more buyers, demand, than sellers, supply. And they will fall when there are more sellers than buyers. Demand is based on the number of traders and investors looking to buy shares. If the demand for a company's shares is high, this will tend to drive up the price. As far as the supply side, when companies issue shares, this represents the number of the company's shares that are available to buy and sell. What pushes people to buy and sell? There isn't an exact reason that can explain the behavior of investors. Instead, there are many factors that could influence their decision to buy or sell. For instance, they think a company has the potential to do well in the future and they want to benefit from its expected success, so they buy shares, pushing the price up. The decision to buy, sell, or hold is based on whether an investor or investment professional believes that the stock is undervalued, overvalued, or correctly valued. If the price of a stock is $100 but is believed to be worth $90, then it is overvalued. If it is believed to be worth $110, then it is undervalued. Besides supply and demand, the valuation of stocks can be influenced by a number of other factors. These can include earnings trends for the company, activity by institutional investors, and market conditions. Can we expect prices to always move? It's very rare to see share prices stagnate. There will usually be a bit of movement, whether it's up or down. Most of the time, share prices will move steadily. But sometimes, prices will swing quickly and abruptly. This is exactly what happens when markets drop, and we would typically talk about high volatility. The bottom line. In order to understand how stock prices are determined, it's important to first know how the capital markets work. Within the capital markets, buyers and sellers collectively help determine the stock price. There are many factors and theories on why stock prices fluctuate, but two theories are the most cited. The efficient market hypothesis says that a stock price reflects a company's true value at any given time. The intrinsic value theory states that companies may trade for more or less than they are worth. If you have any further questions, then make sure you leave a comment below. If you'd like more daily finance content, then make sure you hit that subscribe button to join our community of aspiring entrepreneurs and investors.